Good afternoon, traders. This is Michael James with Uncharted Profits Daily. The market's closed, and we've got a fantastic bearish continuation trade to look at this afternoon on Procter Gamble, symbol PG, which has had a terrible stretch for PG shareholders over the last few weeks as the stock has managed to simply do nothing but fall since starting back on May 15th when it peaked here before heading lower, burying beneath the lower Keltner channel. That's the lower blue line on the chart here, before failing to rally. Last few days got a little bit of a dead cat bounce, and then ultimately PG took out its very minor bullish trend, only 3 candlesticks long, but still a trend line here. When it closed below that trend today, took out that trend, showing us that it might be headed much, much lower now. And we'll get into the reasons as to why that is. But first, I wanted to take a look at something else that's going on that may explain why bear setups are a good idea over the next few weeks as the market attempts to push out even more gains despite the fact that it's so overbought. So let's take a look at the put-call ratio for the total market. And so that's what this is right here. We've got the market's total put-call ratio. So this is all the puts against all the calls for the total market. And this purple line here is the 5-day moving average applied to that data. So if I show this, you can see these are actually weekly candlesticks for the put-call ratio. Once they're applied to, it's kind of hard to see it this way and make sense of it, but once they're applied to a 5-day moving average, or a 5-week moving average, I should say, it becomes much clearer. So in this case, a low put-call ratio simply means that there are not many puts relative to calls. There's a lot of calls out there, or not a lot of puts. And so when the put-call ratio is extremely low or makes a new low, that tends to be a great indicator of a market top, especially when that put-call ratio starts to head higher. So it's done nothing but dive lower here. As this thing starts to rebound, puts come back on, all the calls start to fall away. That's when you start to see the S&P fall lower. And so we're going to plot this orange line here. That is the S&P 500 relative to now the 5-week moving average on the put-call ratio. And so you can see it's kind of an inverse chart. Whenever the put-call ratio dips, hits a low and heads higher, the S&P 500 then sells off. It's a pretty solid relationship that has held over time. Conversely, whenever the put-call ratio peaks and then heads lower, that tends to represent a low or a bottom, before which the S&P then rallies. And so what's important about this is not just that the put-call ratio has fallen so much and that markets are so overly bullish, it's that the put-call ratio is now below several key levels. You can see the low here from January 2023 and the low here from November 28th, 2022. And so these both represented moments in which the put-call ratio was very low. Stocks ended up turning lower in the short term before rallying each time. So S&P sold off, rallied, sold off, big rally to where we are now, near a 90-day high for the market, as tech stocks have totally taken over the big five. We've got a very top-heavy index, as other stocks have not done as well. Nonetheless, in both times that this thing bottomed, the put-call ratio bottomed, the market sold off before rallying. Now, though, the last time we were this low in the put-call ratio was back here in April 11th, 2022, and the months that followed. That time, when it got that low, we had a big sell-off as part of 2022's horror year for bulls, which was very bad, saw the market end in a bear market for the year. And so this is signaling that we may be in for a rough ride, for bulls at least, and buy, hold, and hope investors over the next few weeks if this put-call ratio starts to head higher, which it always does eventually. It never stays buried forever. And so an uptick in this will coincide with a sell-off in the S&P as part of what's looking to be a bigger bearish move. And so that's why it makes so much sense to examine and focus on and really take a closer look on those bearish continuation setups and bearish reversals on stocks that have done well over the last few weeks. But before we talk about the specific PG trade, I did want to touch on the fact that the methodology I'll be talking about here is the exact same one we use to select Uncharted Profits Daily Trade Alerts. The same ones that you can receive in your inbox every day after the market closes that have done fantastic this year. The market is up, that's true, but UPD alerts have done even better, scoring huge gains month after month up until May, which was a bit flat due to the fact that the debt ceiling debate was going on and the market really didn't move all that much. But up until then, we had, I think at one point, 8 winning trades in a row, max gains through February, had a great March and a good April. And the nice thing about it is that it not only gets you into the move, but it makes sure to get you out before the market snaps back against you, which is something I'm sure all traders have experienced, especially over these last few weeks, as they watch their position do great up until the point at which it snaps back, eats up a lot of their gains, and they get out with a small gain, disappointed. And this method does a great job at getting you out in time too. Okay, so let's take a look at Procter Gamble, PG. And there's a lot going on with this stock. Many reasons why bears should be excited about it. The first of which, though, is the fact that PG failed to rally here after selling off over the last few weeks. PG sold off here after peaking on May 15th, traded lower, blew past the 10 and 20-day moving averages, headed lower still, rebounded or attempted to rebound on May 31st, set what looked like support right here along this line, green line, traded higher, rose above the 10-day moving average and closed above it. That's the purple line running up and down the chart right here, which to many traders would be a bullish signal or a signal of a bullish reversal. Closes above the 10. That's a popular bullish reversal signal. Then it traded higher the following day, which may have even triggered a lot of bullish positions. Right before today happened, PG closed lower, sunk again below that 10-day moving average, and is now giving traders a bearish look, a bearish tilt to this stock. And so why was this bullish reversal setup a bad idea? Well, first and foremost, the 10-day moving average here, while a close above it is nice, and you like to see that, and that's going to happen on a bullish reversal, in this case, the 10 is moving lower too quickly. It is zooming lower, and it did moderate a bit here, but not nearly enough to make a convincing move higher, or at least to convince traders that this thing is going to go higher still. In addition, if you look back here, typically what I like to do is trade and take bull setups only on technical higher lows. So that's simply, we've got a low here. I want to see another low nearby that is below this low. So this would be a higher low, classic bullish formation, in addition to a bunch of other things, close above the 10 and some other technical aspects that signal this thing's going to go higher here. This PG is going to rally. But if you go back, you can see that there was a low here. And sure, longer look, this looks like a longer-term higher low if you don't count this one or any of the others, which are more minor higher lows. This is really the big standout one. Got big support back here. The problem with that thinking, though, is that this low is so far away. This is back in March 9th. That is almost 3 months ago. There's a great indicator to look at that. You flip it on for swing highs and swing lows. You can see here we've got these lows. And so, yes, they are lower than this low, making this a higher low, but we also have a low here. And so really, this is a lower low, isn't it? Some traders may have missed that. They see this, they get happy, excited. They see the close above the 10. Okay, well, regardless, we've got a lower low now, really. A failed breakout above the 10. And more importantly, for bears now, we have a lower high. So this high right here, along this red line, relative to this recent red line high back there from May 16th, that is a lower high. And that's bad news for bulls who just took this trade, especially since PG just closed below the 10-day moving average. Finally, another great reason to go bearish on this stock, or to feel bearish about this stock, is that the stochastic indicator at the bottom of the chart here is reading at 57.95. Now, I know a lot of traders like to see stochastic indicator readings for puts or for bear setups, for shorts. above 20, because any reading below 20 would signal that the stock is oversold per the stochastic indicator definition of oversold is a reading below 20 in this white area down here. However, for bearish continuations, especially those that follow a little snap-up rally right here, I really like to see the stochastic indicator reading above 40. And the reason being that Procter & Gamble needs to plow through support here if it's going to go much lower. And if it hits oversold territory, 20 or less, before it hits support, chances are that thing might head higher again. That's not good for bears trying to take continuation trades lower. It might happen. It might still go lower, but it's a higher probability trade to take trades where the stochastic indicator reading is higher than 20, significantly higher, really higher than 40, like I said, as it has support nearby that it really needs to conquer and get over before this trade becomes successful for bears trying to take it lower. And so those are all fantastic reasons as to why bears should love Procter & Gamble over the next few weeks here, in which I would not be surprised at all it would fall significantly, blowing past support if it traded much lower tomorrow or the day after. Now, if you'd like to get my Uncharted Profits Daily alerts sent to your email along with specific entry price recommendations, all you have to do is go to unchartedprofits.com/alerts right here and click this button and fill out your information in these fields, and you'll have the next free alert in your inbox when it's ready. All right, guys, I hope you enjoyed the video. You saw why PG could be a bear's delight here, considering all these factors we just talked about. I'll talk to you next time. Until then, happy trading.